Welcome everybody to the webinar Trading Psychology and Discipline with Thomas. I'm Thomas. I will be presenting the webinar today. I hope that everyone will enjoy. A little bit about myself. I've been working in AvaTrade for the last few years. I had the opportunity to work with many clients and assist them. And today I will be sharing some of the insights and common mistakes that normally occurring when clients are trading, and some of the main things that traders are encountering when trading. They do share it with the account manager, and I'll be happy to share with you today. So just to start with the risk disclosure, any capital markets and trading information disclosed in this webinar is provided for informative purposes only and should not be constructed or applied as investment advice, a recommendation or suggestion. CFDs are a complex trading instrument and come with a high risk of losing money rapidly. Due to 57% of retail investor account lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing money. Please read our full disclosure at AvaTrade website. So, webinar agenda will be discussing trading basics, profit and loss calculation, order types, trading psychology in general, risk management, platform essentials, opening and closing position, pending order, stop loss, take profit, margin calculator, trading history, features we have like AVAProtect, account types and benefits, standard, VIP, different account types that we offer, account metrics, balance equity, free margin, use margin, and hedging strategy, how it works with hedging, how to better learn how to use our platform. So here you can see this is a WebTrader. We'll show you. Over here, this is my Ava, where when you log in, you'll be able to see this page. When you click here, you see my account. You'll be able to see all of your accounts. If right now you only have one account, you can also click add an account, and you can have another real account if you'd like to have few real accounts, or you can set up also a demo account. Once you go on one of these accounts, for instance, if you click here on the web trading, it will be directing you to our WebTrader. Just need to renew the session. If you're not logged in for more than some time, it will require you to log in again. You hit the confirm button, so it will redirect you to the relevant page. And this is the WebTrader page. Here you can see on the left top, if you click, you see my accounts, payments, tools. Under my accounts, we have accounts, verify the account, personal details. Under payments, you have transaction history, balance history. And the tools, you can set here different alerts. So if you go back to my account, you'll be able to review all of your accounts. And again, if you want to have another live or a demo, I suggest to have a demo for the sake of the demonstration where you can place orders while we are on the webinar itself. Now, the first option we have on the left is trade. On the trade, you can see you have an option to search for a symbol. If you are considering whether to trade on MT4 or whether to trade on MT5, the main difference will be that on MT5 you have a larger selections of stock available to you. Also, the trailing stop you have on MT5. So, if you wish to use MT5, also you have nano lots available opposed to the MetaTrader 4. But obviously, it's up to you. This is just the physical difference that many traders are asking from time to time. They're asking me, Thomas, what's the difference between MT4 and MT5? Here you can see it is divided by 6 different sections. You have the favorites that you can set here, your own favorites, the instruments that you wish to trade on. You'll be able to add them on the favorites. Then you have trends, hot. Click on hot, and then you will see some different instruments that are also available. It is divided by different sections. Then you have most rising, most falling, most buying, most selling. It's meant basically to give you some ideas on what things you can trade. Then you have below Forex, is the currencies, indices, crypto, commodities, stocks, and so on. Below you have positions. Here you will be able to see your open trades. So you have no open positions at the moment. Orders, we'll go through it today. You'll be able to see your pending order, history. You can decide whether you want to see last 7 days, last 30 days, last year, last month. Then you have signals, news, discovery. And over here you can see some tutorials, academy, and you can see here the live chat that you can contact our customer support if you need any assistance with something. So basically, our webinar, the Trading Psychology, we have done a few webinars before. You can feel free always to watch the webinars that we had before, because some of the webinars are basically being built up and are different between each one of the webinars. In general, trading psychology is when you trade, when you are trading. Psychology is something that is very important, because according to the psychology, it will determine whether you are opening a trade or closing a trade, when you are opening the position, whether you are following a certain plan. So everything to do with this is not really relevant to your analysis itself. So it is divided by 2 sections. So the first thing is to do the analysis. But after that you already have done your analysis, you will need to have a certain psychology strategy that will enable you to implement it correctly without any interference that can be caused by stress or by many different things, by being excited that the market is going up or the market is going down. And due to that excitement, it's causing you to wanting to close more position or wanting you to open more position. And sometimes you are closing a position that was supposed to be profitable, and after that you close the trade, you are not following your strategy and it's causing you to lose money. So the psychology of trading is meant for you to know what you are doing and to follow your strategy and to have a certain plan and to follow that plan that you have. And of course, know how to calculate profits, how to calculate losses, and to be informed of what is happening with the account. What is your risk appetite? How much money you are willing to risk? How much money you are willing to profit in terms of when to close the position? So this is a very, very important part of trading that have everything to do with the psychology and nothing to do with the actual analysis. So this is what we will be doing in our webinar. We will be discussing psychology, what things you can use to improve your psychology. And for me, I always recommend traders to actually take it very seriously. Not only the analysis, which is obviously important, but also the discipline, the psychology. So you know how many positions you want to open a day or a week or a month. You know why you want to open a position based on fundamental, based on technical, based on a certain strategy that you decide when the price hits a certain point. You want to buy or to sell an instrument. So this is just a summary for you to get a better understanding how important it is to have a good psychology that will enable you to trade. And today we will be discussing some tools that can help you. So we go back to the presentation. So as we mentioned, the regular window, and here you can see when you log into the WebTrader on the top right corner, you can see the trading account overview panel. This is very important. You can see here all the information about your account in terms of everything you need to know about your balance, free margin, use margin, profit, equity. I can tell you that from my experience, not all of the traders know how to use and navigate throughout the trading account funnel. And I will share with you today why it is so important. But when you are trading, you need to understand, first of all, a very big common mistake that traders are doing is that they are looking too much on the balance. So once and for all, I will clarify that the balance represent your closed positions. What does it mean? It means that when you close a trade, the balance will adjust. So if I close a position with a loss, what will happen? The balance will go down. If I close a position with a profit, what will happen? The balance will go up. However, the balance does not tell me how much real money I have in my account, including my open positions. So for that, you will need to look at the equity, and this is the number and the amount of money that you have in the account. So if you will be closing all of your positions, you will be left with the equity. The used margin will represent the amount of margin that is being used for the position that you have already opened. That's equivalent to the used margin. What is in general margin? Margin is money that is being used to open positions. Use margin is how much available money you have to open new positions. So if we go through the definition itself, balance, your balance represents the result of all closed positions only, does not include any profit or loss from open trade. Every time you close a trade, the balance adjusts accordingly. If you close all open positions, your balance is equivalent to your free margin and is equivalent to your equity, and also the margin level will be equivalent to nothing. You will not see a margin level there if you don't have open trades. The free margin is the amount of money available for opening new positions. When you close the position that is not hedged, the free margin increases according to the amount of used margin that gets released back into your account. What does it mean? It means that if it requires X amount of margin to place an order, when you close the order, the margin that was required will go back to your free margin. I will share with you how it looks like live. Equity represents the real value of the account, including your balance plus floating profit and loss from open positions. That means equity shows how much money you would have if you close all positions right now. Use margin represent margin currently being used for open positions. The amount of use margin depends on the position size, the instrument you are trading, the leverage applied, which varies based on the jurisdiction in which your account is registered. There's also a question we get a lot about the leverage. The leverage is something that depends on the country that you registered from. If you registered in EU, the leverage applied to you will be for EU clients up to 1 to 30. If you are outside of EU, the leverage will be up to 1 to 400. Depends again on the country that you are on. And if you are an EU client and you want to trade on a professional account, you will be able to apply for a pro account if you can get the required documents that show that you are eligible for that category. Now, margin level, when you open a new order, you will see your margin level in percentage at the top right corner of the platform. It is important to monitor this value when you have open positions. Margin level formula, equity divided by use margin, multiply that by 100 for the non-EU clients. If the margin level drops below 10%, stop out will be triggered. For EU, non-pro clients, stop out occurs if the margin level falls below 50%. When the stop out is triggered, the position will be closed automatically. Margin increase when you close a position, the use margin that was allocated to open the trade is released back into your free margin. As a result, your margin level will increase. And now I'm going to share with you so you can see live how it's going to work. Now here we have the balance free margin, used margin, equity. I choose a random position, whatever I want. I click on it, and this is important. You see the new order page opens on the right. This is a page with a higher leverage. My account is based outside of EU. Now, what we see here, we have the instrument called, we have the sell, the buy, difference is spreads. We have the lot. The lot represents the amount of profit and loss that you will basically have per each point. So if you trade on a smaller lot size, you will be making a smaller profit or loss per each point the market moves with you or against you. And when you increase the lot size, you will also increase the amount Troy Oz, which is the measurement. Then we have the value. Then we have, by the way, the value is, as you can see, is the amount of Troy multiplied by the price is equivalent to the value. The margin impact is very important. This is the amount of money that is required for me to open the trade. For the sake of the example, if one lot I can trade, two lot I can trade barely. You see, because the margin impact is equivalent to 4,423. My margin is 4,500. So if I choose 2.1, I cannot trade because I don't have enough margin. 2.01, I can still trade. 2.02, I can still trade. 2.03, I can still trade. And 2.04, can barely. And 2.05, I cannot. So let's go with the full exposure. The biggest position size I can open is equivalent to 2.04. And this position will max out all of my free margin. As soon as I click to buy and execute the order, you will see that your margin, your free margin will drop. So let's give you an example. I click buy, and as you can see, your free margin dropped. Why is it minus? It was minus. Now it is positive, and the balance remains the same. The use margin is how much margin was required to open the trade. You see the profit that I'm having right now. You see the equity, and you see the margin level in percentage is 104, 103, 102%. It's moving. Now, if I want to monitor the position, I click on positions, and I can see the position size, what is the symbol, what is the size, the value, the P&L, the open price. I can add a stop loss, I can add a take profit, and if I wish to close the position, I click here on the X. I can also close a portion out of the position. Now I just click close position, and the position was closed. I then can go to the history, and I can see over here the profit and loss I had on the position. Now we go back to the same page we were. We go back to the presentation so we can keep covering up more subjects. So yeah, the use margin I showed you, the margin got back to the account once I closed it. Hedging, basically what is a hedging is a position that you open on the same instrument, on the same lot size, of course, and different direction, one buy, one sell. So if you open two positions on the same instrument with the same lot size but in opposite direction, one buy and one sell, this is called hedging. In a hedge, the margin required to open a position, the second position will be zero. For example, one lot on euro dollar with the 1 to 400 leverage requires approximately 275 in margin. If your first position is buy and the second position is sell, the same size and the same instrument. The second trade will be considered as a hedge and will not be required for any additional margin. The same applies if the first position is sell and the second position is buy. The only condition in order for you to be able to hedge a trade, your margin level needs to be above 100%. If it's not, the system will not allow you to open a hedge position. Now let me share how it looks like. So now we don't have any positions open on gold. So we're going to start the first position with the 0.1 lot on gold buy. Now, in order to hedge that position, what we will do, we will open 0.1 sell, and you can see the required margin is nothing. So once I open the position, what I have right now here is two positions, one buy, one sell. And I didn't really need an extra margin for that. When would you use hedging is entirely up to you. You can use it at different kind of occasions. But if right now you just open a one buy, one sell, so in terms of strategy, it's not giving you the same advantage of opening a hedge position with different times and different values that will enable you to have a certain price range for an instrument. So for example, if the value of gold is going to a certain direction, up or down, okay, imagine that the value is going and increasing in value up to a certain point. Let's say in percentage, it's going up in 30%. And then after 30%, you as a trader think that it's going to start dropping. So in that case, what you can do, you can open a hedge position after the 30% increase, and you will be able to also make profit when it's going to drop. So this is just something that many traders, they love to use that strategy of hedging, and it's a tool that you should be aware and familiar of. So this is the new order page I showed you before. The features, buy and sell, the lot size, the margin impact. The lot size is also very important because this is also something that traders are not being cautious about when trading on a very big position size and trading on a bigger lot size than what they should have, or trading on a smaller lot size than what they should have. Basically, you are the one who's in charge of your account. You are the one who is in charge of your risk appetite and your exposure. And of course, if you want to have a bigger risk, you can trade on a bigger lot size. And if you want to trade on a smaller risk, you can trade on a smaller lot size. And I will share with you a few examples. Before we go to AVAProtect, I will just share with you. Let me close these two trades. I click close. And you see now I have a certain drop. So if I want, I can open another position and hedge it. Just for the sake of the example, if we have here a position on gold, it's losing 26, it's losing 40, it's losing 40. If it's losing, means the value went down. So in that case, it's not hedging, but what we are doing here with position that was, it was 10 in terms of the size. I've called, and you take the same position here, 0.1. What we've done here is basically securing a better pricing point for the position, which basically means is that I open a position on gold. The first price that I open is 44.26.48, and then there was a drop. I open another trade on 44.30, and you see here the value. So if I see the value drops more, then in that case I could open another buy position, and then you're basically just securing yourself with different pricing point. You can use this strategy when you see that you have a big increase in percentage or a big decrease in percentage, and you want to secure different pricing and to have a different kind of positions available to you. So we will keep these two. If it will drop more or if it will not, you will be able to see shortly. And before I went to the AVAProtect, I just wanted to discuss the lot sizing. So what kind of option we have? For instance, you have 100 lot. It will require you 221,000 to open a trade. This is the biggest position size you can open. You need also to check what is the exposure limit on gold, so you know if it's possible for you to open such a big position, and it's getting closer to the exposure limit. But the point is that you only need $221,000 to open that trade, and this is just an example. You can take 10 lot, 1 lot, 0.1 lot, 0.01 lot, and I will be sharing with you what is the difference in the values. So what happens when you see here below, you have different options, 4 options. So we go with AVAProtect. I will share execute when price sheet. I will share with you now. And just for the sake of the example, the take profit and stop loss are 2 orders that you can set, and you can ask the system to close the position when the value hit a certain point that you select. So for the sake of the example, let's say we put $4.5 thousand per ounce of gold. So I want the system to tell me when the price of gold reaches 4.5 thousand, what will be my possible profit? So you see it's about $70 with 0.01 lot. For 0.1 lot, it's $700. For 1 lot, it's $7,000. For 10 lot, it's $70,000. And for 100 lot, it's $670,000 of profit that you will make when the price reach that point. So that's how it works, basically. And also, you have commissions that you have to pay, and you have different type of commission. The spreads, we have the swaps, And here you can see on the two positions I open, we have $60 and $22. We have profit on these two positions. And what it means that the value of gold went up. And as I mentioned to you before, after I open a position, I see certain change in percentage. I could go and place a position, for example, sell in order for me to benefit from a potential drop. Why would I want to do it after a certain increase? This increase is very low, but I'm just sharing with you in general so you can get a better understanding. And then I take the same position as I had before, because now I want to secure a lower price. And you see I have these two positions with the profit, and I close them. I close these two positions, I make $100 profit. And then I secured another position when the price went lower. These positions, I can let it run, see what happens if it goes up or down. And then I know whether I want to open another position or not. So I was about to talk about when I changed the price to 4,500, I was talking about how you can see the possible profit. Same thing you can do about possible loss. Let's say you change it to 4,400, 0.01. When the price of gold reach 4,400, the possible loss will be around $34, $35 for 0.01. For 0.1 lot, it's going to be around 340. For one lot, it's going to be around 3.3 thousand. For 10 lot will be a loss of 32,000. 100 lot will be a loss of $300,000. And this is a tool that you can use to do calculation, to set your risk and to set your strategies. The system, how it works, basically, is that we do not provide a guarantee on your stop loss, which basically means is that when the market is moving, if the pricing point that you have selected, they have reached, the system will just close the position at the stop loss price that you have selected. And from time to time, it does happen that there is a market gap and the position gets closed at the next available price, which means that the possible loss that you set here is an estimate. The price is not an estimate. So when the system reaches this price, it will always try to execute closure, but not always it will give you the exact pricing point that you have selected. The reason why I'm sharing, because you as a trader, you need to know what is stop loss and what is stop loss guarantee and what is the take profit and what is the take profit guarantee. And some traders, they really like to use the stop loss because in terms of the psychology of trading, you let it go, you open the trade, you copy a certain strategy that you follow, and then you let it go. You let the price reach the price you set, and in terms of emotions, you don't have emotions because the position is already secured. You set your take profit, you set your stop loss, and everything is good. So sometimes some people like to set this position. Also, you can add execute when price hits, which is which is a pending order. And just regarding the positions we open here, you can see we have a sell position with $31 profit. Let's say I want to secure that position, secure the price. Secure meaning that once the price reaches a certain point, I want to have another position because now the price went down. So if I think it's going to keep dropping, I can open another sell. But for the sake of the example, I will take the certain small percentage of drop, and I will now try to enjoy it, and I will open a buy position here. Which means that if there was a certain downfall that made me $40, after the downfall, I open a position with the opposite direction. So it means that I'm getting a better price on the second position, and on the first position, I'm going to close it with $50 profit. And this position, I'm going to let it go. I'm going to check what's going to be the difference in pricing, and I'm going to keep sharing with you. So we discussed the take profit, discussed the stop loss. The take profit calculator, you have the two sides. You have the left side, you put the price, and you have the right side, you put the possible profit. And that's what I wanted to share here. Let's go through the execute when price hits. This is the pending order. This is an order that will only be open when the market reaches certain value. Only then the position will be open automatically. You put the lot size that you want. Let's say we want 0.1. Let's say I want the system to open gold when the price reach, let's say 4400. Which I want to have a take profit at 4410. It's giving me $100 profit. I want to have a stop loss for let's say for 390 or for 395. And then when I execute the order, you can see here the pending order that you have open. The distance, the trigger price, and also look, this position is also in profit, but we keep it for now. We go back to the page, the new order page. So we discussed the execute when prices, a pending order, take profit, stop loss, AVAProtect. This is a product that giving you the ability to have a certain protection on your position. So what happens, you pay a certain amount of money upfront. The amount of money you have to pay will depend on the lot size. If you trade on a bigger lot size, the price of the protection will be higher. Let me give you an example. So for 100 lot, protection for 2 days, I need to pay $367,000 for the protection. If I drop to 10, it's 36. I drop to 1, it's 3.6. add up to 0.1. It's 366. Add up to 0.01, it's $36. Okay? So why would you pay that amount of money? So you're paying money upfront. So if you have a certain negative floating within the duration that you have selected, the negative floating will be reimbursed automatically within that duration, either when the duration expires and you have a certain negative floating on this position. So in that case, it will be reimbursed automatically. Or if you close the position in a loss within that duration, so then the loss will be reimbursed for the position. So the only money that you lose is the money that you paid for the protection. Basically, that's how it works. It has nothing to do with the losses. If you have losses on spreads or swaps, it's not losses, it's fees, something completely different. This is related with feasible losses that you are having. If your position is in a profit, by the end of the duration, it will keep going. You need to open another protection if you want. And we will just go through here some examples. And then we will be finishing our webinar for today. So AvaProtect is a feature that allows you to limit your losses for a predetermined cost shown before placing the order. For a limited protection period, any losses you incur will be automatically reimbursed either when you close the position within the protection time or when the protection period ends. Only the position open with protection is covered with the relevant protection offered. If you choose a bigger position size or increase the protection duration, the cost of AVAProtect will increase accordingly. Okay, so as you can see, I showed you before, let's say one lot, you pay 1.2, 1090.37 for one lot. For 2 days, you pay 3,950. For 1 hour, you pay 1,290. These are just 2 examples. 1 day, 1 hour, and then 2 days examples for the same lot size. And here you can see a smaller position, 0.01 lot for 1 hour is $12.97, and a 0.01 lot for 2 days is $39.52. What is required from you to place an order with AVAProtect? You must have enough free margin to open the position. Your free margin must be higher than the margin impact plus the protection of the cost. So you pay the protection, the amount that is required, you pay it straight away when you open the order. When will the charges appear on my account? You are being charged for the protection immediately when the position is open. How will my losses will be reimbursed? Losses will be reimbursed under 2 conditions. If you close the position during the protection period, so automatically you see the loss is being reimbursed. If the protection period expires with a negative floating, the loss is reimbursed automatically, again within the duration for the protection. Only losses that occur inside the protection time are covered, which means that if you hold it after the protection expires, in that case, nothing will be covered after the protection expired. So you can close the trade and open a new trade if you want. How do I make profit with AvaProtect? You must earn more profit than the cost of the protection and also the cost of any commission you have there, spreads or swaps. What happens if my position continues after the protection expires. As I mentioned, any losses after the protection expires are not reimbursed. Only the negative floating inside the protection duration is covered. If there is no negative floating, so it means position is in profit, you have no reimbursement. Let's give you a few examples. Example 1, small position 0.01 lot on gold, 2-day protection cost $39.33. The negative floating, for example, was 100. At the expiry, you get $100 reimbursed automatically because it's the end of the duration. You effectively save $60 because you were supposed to lose 100. Example 2, a larger position, 1 lot on gold, 2-day protection, cost $3,933. Negative floating, for example, is $10,000. You get reimbursed $10,000 and you save $6,000 because you were supposed to lose $10,000. Example 3, profit scenario, small position. So let's say you open a trade with 0.01 lot on gold. The protection cost is $39.33. If you end up with $10 profit, you have no reimbursement. Another example, profit scenario, larger position, 1 lot, protection cost $3,933. If you end up with a profit of $2,000, you won't have any reimbursement, and also you are actually losing because of the fact that the protection cost $3,933 and you only closed it with a profit of $2,000, so it means you lost almost $2,000 because you used that protection. I execute when price hits, we covered. Take profit, we covered. And that was basically the major things that we were supposed to cover today in our webinar. I will just follow up regarding that position on gold. What I opened with the buy position, I secured a better price because previously it was sell, the price went down, and then the price went up again. And for the sake of the example, what I will be doing, I will be securing another price on gold with the same position as well, 0.1. Now I will take the opposite direction, which is equivalent to sell, 0.1. And after I have a certain increase in value, as you can see here, I already made $9, and I'm going to close the first position with a profit. And the second position is already making me money, $23, $22. So this strategy basically has nothing to do with the psychology of trading. I'm just showing you how to use the platform and different ways that you can open positions, close positions. And I hope everyone enjoyed this webinar. We will be having another webinar at the same time next week. I wish everyone a successful and fruitful trading journey. And for any of you that are starting out, I know the beginning may be a little bit challenging. Obviously, it's not easy to generate a successful trading journey and have a positive return on investment, but this is something that you can focus on and you can improve your trading. And remember that you have the psychology part that is basically whether you are opening position, closing positions, and it's very important to have a plan and to be disciplined. So you also know how to journal your trading, and we have discussed before how to set a trading journal and what to include in the journal, and how you can learn from your trading so you can improve it for the future. Goodbye, everyone, and we will be following up in our next webinar next week. You can also visit our previous webinars if you would like. And all the best. Bye-bye, everyone.